Storm clouds gathered over the U.S. stock market as shares took a record dive on Wednesday. Who's to blame? Is this just a temporary tempest or a precursor for worse financial woes to come? And the Chinese government is slashing the prices of life-saving cancer drugs. How will patients benefit from the new prices? Welcome to The Point. Live from Beijing, I'm Li Xin. The U.S. stock market took an alarming plunge on Wednesday, its biggest loss in months. The Dow Jones Industrial Average lost nearly 3.2% or 830 points, and the S&P 500 slumped 3.3% or 94 points, the most dramatic one-day drop for both since February this year. The Nasdaq fell 316 points or 4.1%, its largest single-day sell-off since June 2016. The downward trend continued Thursday, with the Dow dropping another 545 points. The crash has spooked investors, triggered uncertainty in other markets, and raised fears of another looming global financial crisis. What's behind the slump? How is financial turbulence in the U.S. infecting other economies? And can the U.S. stock market correct itself, or are we on the brink of more financial trauma ahead? Joining me for the discussion in the Beijing studio is Zhao Hai, Research Fellow at the Chinese Academy of Social Sciences, and from Washington, D.C., Joel Rubin, former U.S. Deputy Assistant Secretary of State. Gentlemen, welcome to the show. So first question to Joel, if I may, why? We know the U.S. Federal Reserve has hiked interest rates 3 times already this year. The IMF, the International Monetary Fund, cut its global growth forecast on Tuesday for the first time in 2 years, saying growth is predicted to be 3.7% this year. Next, down 1/5 of a percentage point from an earlier forecast. And there is the geopolitical factors such as the U.S.-China trade war. So what have been the most significant factors behind this drop?
Well, thank you for having me. And certainly, interest rates have direct impact on the stock market and on our Wall Street perceptions of future growth. And interest rates have risen steadily, but that's been a trend now for some time, and it's because of the consistent growth in the American economy. We've been in a recovery for the past decade now, since the 2008 financial crisis. Things are heating up quite a bit here as well, and that's part of the concern, is that domestically we may be, as we like to say here, juicing the economy too much with tax cuts and additional federal spending, an annual deficit nearing $1 trillion, which is an extraordinary amount of money for the United States to be piling on in our deficit. So the Fed looks at that and gets concerned and raises interest rates that have been at historic lows a little bit, and that does tend to temper markets. So that's some of the underlying drivers behind this, in addition to some political uncertainties related to trade between China and the United States as well, just over the horizon.
Sure. So what would you say would be the biggest difference between this week's drop and the last major drop in February? How is the economic ecosystem or climate different this time around? Joel, still to you.
Well, I think politically, economically, the fundamentals are still consistent with where we were back in February in terms of the American economy, but politically there's a different view now of what the capacity is of Washington to help support the economy when there are dips, as we're seeing, and that goes to the earlier point I brought up, which is the trade tensions and the uncertainty about that, and about how long that may play out, which does impact technology, does impact long-term investment. It does impact, as we've seen as well, a significant economic activity in the interior of the United States as well, in farm country, in the manufacturing sector. So we have economic growth, we have fears down the road, and there is a concern that perhaps Washington doesn't right now have as much capacity or even a policy that would help to temper some of the shocks that we've seen in the past week. So it's a little bit more of a free-floating dynamic as compared to
Okay,
February.
Mr. Zhao, what is your take on the same question, the difference between the ecosystem of the U.S. economy now versus in February?
I think other than what our colleagues just said,
yeah.
There's another factor probably, that is the American midterm election that is coming up in November, because more and more predictions saying that Democrats may take over the House, and also that's going to pose a grave threat to Trump's administration. And Trump's administration has a very pro-growth program, and so far they've been cutting taxes, they've been deregulating, and the economy is accelerating. So you have a much higher growth rate and also much lower unemployment rate at this point. People are concerned about rates, but also they're concerned about the potential of growth next year and what's going to happen down the road. And plus, what's happening right now is that the Trump administration is finishing up its first whole year budget, and from that budget we see that they have running up close to $800 billion of deficit this fiscal year, and next fiscal year is predicted to be $1.2 trillion. So adding those up, you'll have a much higher national debt in the U.S., and the market is concerned about how much the rate can sustain at this point.
Okay, in response to the drop, President Trump said this on Wednesday. Let's listen in.
Correction that we've been waiting for a long time, but I really disagree with what the Fed is doing. I think the Fed is making a mistake. They're so tight. I think the Fed has gone crazy. So you could say that, well, that's a lot of safety, actually, and it is a lot of safety, and it gives you a lot of margin. But I think the Fed has gone crazy.
So, Joel, just to paraphrase, if you didn't hear properly, basically President Trump calling the Federal Reserve going crazy here. Do you think the Federal Reserve is to blame here, or is Trump really making the Fed a scapegoat for something else?
Well, first of all, I have to say this. Crazy is what we saw yesterday in the Oval Office when the rapper Kanye West was speaking to the president in an extemporaneous way that made no sense to most Americans watching. The Federal Reserve has not gone crazy. The Federal Reserve is watching the American economy, engaging, as we've been discussing, the balancing act that a deficit-financed economic boom will have on economic growth over time, and attempting to ensure that interest rates manage that growth so that we don't have an economic collapse. So the Fed, this is Jerome Powell was appointed by President Trump not so long ago. It's analogous to the way he's treating Attorney General Jeff Sessions, who he also appointed. He is seeming to be bullying the Fed, which is really not a good idea. The Fed needs to maintain its independence to manage the economy. It's not a tool of President Trump's economic policies. It's a tool of the American people's ability to have an economy that works for us over time.
So basically he didn't really care about the rules, about presidents not saying too much, not interfering in the Federal Reserve's decision to show its respect for its independence. But what are the bases for his judgment? I mean, basically the Fed is saying we are raising the interest rates because there is signs of, or for fear of overheating further down the line. So where does President Trump get his judgment, Zhao Hai, here? And does he have a better team of economists beside the one that he appointed?
Well, I don't think he really cares about what his economists are saying about the market and also the economic rule behind all of this. One thing is clear, the Fed is increasing the rate steadily according to U.S. economy and the concern about the inflation down the road. Particularly, the Fed has pointed out the concern about U.S.-China trade war and what it might bring to the market. What happened to the U.S. stock market is actually it increased dramatically over the past year and a half since Trump took over the office. It has risen over 23% in a very short time period, and compared to other asset class, the stock market, the equity market is no longer that attractive. So I think it's time, actually delayed, for the market to correct itself instead of blame the Fed.
Another indices that is very interesting is the CBOE volatility index, known as the VIX, which is the most watched measure of investor anxiety, which spiked on Wednesday by 44%, so the highest in months. So, Jewel, how do you interpret this combination of dropping stocks, even just for the moment, and rising investor anxiety?
Well, can I add as well to what was just said,
Please.
which by our colleague, which is that the American economy existed before President Trump. It will exist after President Trump, and the Fed is safeguarding the American economy. President Trump has a political imperative, a political desire to make the economy boom on his watch, but that's not the goal of the Fed, and that shouldn't be the goal of the American people. It should be to have a stable economy over time. And so I think what you're referring to with this index is maybe now a concern that President Trump is willing to meddle in the economy in a way that will benefit him politically prior to a midterm election rather than to the overall economic health of the country. And when we politicize our economy, it's very dangerous. And it's telling that his Secretary of Treasury, Steve Mnuchin, talked about how the Fed and Jerome Powell, the chairman of the Federal Reserve, is doing a good job trying to allay concerns. We've seen this, allay concerns in the markets. We've seen this kind of action as well taken by the Secretaries of State and Secretaries of Defense in the past, related to North Korea, when the President said things that were very aggressive, and they've said, well, really, we have a good process in play that we're going to execute. So I think right now the economy being politicized is concerning, and that very well could be why this index has spiked.
Yeah, Zhang, what are the impacts of how big of a puzzle is the U.S.-China trade war in the whole thing? And going further, are we going to brace for more troubles?
I think in the short run, because Trump has already stated that his willingness to continue with this U.S.-China trade war is because he believes the China's stock market dropped much more than the U.S. He said Chinese market dropped 25%, the U.S. market is going up 25%. Therefore, he's confident that his current approach is right. Now the stock market seems to be correcting, and he's probably not happy about this. Therefore, he's pointing fingers to the Fed and other factors. However, I think in the long run, regardless of the capital market, what's going on in the trade realm is going to spill over into other areas, and that's going to put investors really in much more have much more concerns.
I have about 10 to 15 seconds. Joel, what are the chances of a big financial crisis brewing here? Your take.
There's one brewing, but it is not inevitable. It very well could be curtailed. The fundamentals do not require that to happen.
Okay, well, that's for another discussion. Many thanks to my two guests, Zhao Hai, Research Fellow at the Chinese Academy of Social Sciences, and Joel Rubin, former U.S. Deputy Assistant Secretary of State. You have been watching The Point with me, Li Xin. We'll take a short break, and when I come back, cancer drug prices are dropping in China. I'll find out why and what it means for patients. Stay right here. China is now including 17 life-saving cancer drugs in its basic medical insurance scheme nationwide after negotiations drastically cut the drugs' prices. On average, these drugs are 57% cheaper than their original retail prices, according to the National Healthcare Security Administration on Thursday. The astronomical price for cancer drugs was the theme of a popular Chinese movie, Dying to Survive, earlier this year. Chinese Premier Li Keqiang cited the movie in an appeal to China's regulators to speed up price cuts for cancer drugs and to reduce the burden on families. According to the National Cancer Registry of China, around 4.3 million new cancer cases and 2.8 million deaths were reported in China in 2015. Beijing began the price negotiations in 2016, and 3 drugs were successfully included in the plan that year. More pharmaceutical companies were invited in the negotiations last year, and 36 more drugs were eventually covered under the basic medical insurance scheme in 2017, and the negotiations will continue next year. How will the drugs bring real benefits to patients? patients. What new hurdles are ahead, and where does China stand in cancer drug affordability? I'm joined by Xu Qingduo, Senior Fellow at Pango Institution in Beijing. In Shanghai, Dr. Mark Xu, Chairman, CEO and President of Sinomic Pharmaceuticals Incorporation, a U.S.-China oncology-focused biotech company that develops drugs to treat lymphoma and solid tumors. And in San Francisco via Skype, Dr. William Polkinghorne, co-founder and CEO of Driver, a first-in-kind treatment access platform for cancer patients. Gentlemen, welcome to the show. Let me go to Dr. Xu first in Shanghai. The new drugs treat solid tumors and lymphoma. Your company also deals with these diseases, and 10 out of the 17 drugs enter the market after 2017. So could you help explain to us how important the drugs are to patients and what the price drop will mean to them?
Yeah, good morning. It's great to have. Thanks for having me. You know, I'm actually looking at the list of the drugs that are being included in the October 10th new directory by the government. I think these are great drugs. You know, for instance, pazopanib, marketed by Novartis, is treating renal cell carcinoma and sarcoma. These are two, you know, some of the most deadly diseases, and they are obviously, you know, being marketed globally at very expensive prices, on average about $120,000 per patient per year. And if the government is able to reduce the price by 60%, I think there are greatly benefits to patients here in China. You know, allowing greater access to these life-saving medications. So
yeah,
I think it's a great initiative.
Yeah, Dr. Xu, officials believe that this is a win-win-win situation for both government, patients, and companies. Why are companies willing to drop their prices and go into the scheme?
You know, I think it's a win-win for the patients and the government. It's not necessarily a short-term win for the companies. I think you know, I speak for the industry, so I know the enormous upfront investment involved in innovating a new drug. So that's why the prices are pretty high when they're still under patent protections. I think for emerging markets like China, multinationals are willing to cut the price to increase the volume of the prescriptions, but they could potentially have a slightly negative impact on the business side as well, because it could, you know, I could, you know, foresee a possibility that when they look at new next generation of drugs, when they introduce the next generation of drugs to the market, China may not be on their top list.
I see. Mr. Xu here in the Beijing studio, having heard what the Dr. Xu said, what do you think? Can you relate to the concerns of these pharma companies? What do you think would be the consideration of the Chinese government trying to negotiate, trying to offer a certain kind of opportunity as well, right?
Yeah, from my understanding, obviously, you know, for the government, it's really about, okay, now lower price, you sell more drugs to more patients, and you have more market share, so we'll profit from a low price. Ultimately, of course, you can keep your prices high, but sell them to a small number of patients, only those who can afford such a high prices. I think at the end of the day, I think you know, it's a win-win-win actually. The government, the patients, and the companies will benefit from such a scheme.
Okay, Mr. Polkinghorne, now patients should be able to purchase these drugs at a lower price by late November. That's according to Chinese authorities. Do you see more hurdles, however, before the patients can access these drugs, such as a short supply at hospitals?
Yeah, I think it's a multifactorial problem. Countries all over the world are struggling with how to pay for this. What's happened is 20, 30 years ago, going to see an oncologist was like going to the McDonald's. There were a couple things on the menu: cheeseburger, French fries, chicken McNuggets. And then all of a sudden there was this explosion. An explosion of options, an explosion of treatment algorithms. And that's created a twofold problem. One is how to pay for these treatments. We've gone from a world of McDonald's to a world of walking into an oncologist office with one of those menus with 1,000 pages. And then the second problem, which I don't think we talk about enough,
Yeah.
is in a world where all of these treatments can be paid for, are patients even getting the right treatment? And the data coming out of the United States is overwhelming, that even in worlds where these drugs are paid for, often patients are getting them inappropriately. So to me, it's twofold. One, obviously patients should have access to the full menu of options and find some way to have those paid for or pay for them directly. But the looming question now is, in a world where those options all exist, why is it that so many patients don't get the right treatment?
Okay. Well, just a side question here. You have opened an office in Shanghai. So how do you look at the kind of work that Chinese government or Chinese hospitals have been trying in providing the right medicine and the right treatment for the Chinese patients?
Yeah. So we have two flagship partners, one here in the United States, the National Cancer Institute, and one in China, the NCC in Beijing. And so we've been working closely with them to develop a tool for the oncologists, to empower the oncologists to have access to all of their options, to share all of those options with the patient. So I think China is a really, really, really exciting opportunity to develop a new model from scratch. There aren't enough oncologists. There's a big study that came out yesterday in the United States about the shortage of oncologists in the US. China has per capita 1/10 the number of oncologists as the United States. So I think there's an enormous appetite for exploring radical new models that are going to empower that population in China to have access to cancer treatments.
Absolutely. And I think the effort to bring down the price of cancer drugs is part of the effort to help cancer patients in general. Now,
incredibly important.
Yeah. Well, in terms of local affordability of cancer drugs, China has emerged as one of the countries with the least affordable prices in the world. According to a study released in 2016, the median price of 1 month dosage of patented cancer drugs in China is around $3,000 US. In the US, the number is 8,600. India, around 1,500, and in the UK, that's about 2,600. In this sense, the price doesn't seem that high in China, but in terms of percentage to per capita GDP, the number for China is 270%. Compared with the US of 190% and the UK a mere 78%. India, however, is higher than China. The 1 month dosage of patented cancer drugs is over 300% of per capita GDP, but India is a different case. So, Dr. Xu in Shanghai, from a drug maker's point of view, what has caused this kind of discrepancy?
I think it's really it's country by country. So U.S. is a free market, so basically it's the pricing determined by the company as well as the insurance payers. So it's really a free free pricing system. In UK, I think they have a national system called an agency called NICE, which reviews the new drugs as well as comparing their potential clinical benefits. Similar to China's Reform Development Committee. So UK has a more rigorous pricing control on innovative cancer drugs. I think China is somewhere in between. India, as you mentioned, it's a little bit different. So I think China, because of the the cost of transportation and also some of the import taxes that was levied several years ago, has a higher price in terms of percentage of GDP. So, but I think that's changing based on the negotiations that the government has been able to achieve with the pharma companies. I think that's, again, it's a great progress.
Chinese government is also putting a lot of emphasis on this. Premier Li Keqiang has rallied for speeding up price cuts for cancer medications. The issue is, however, so complex that he has already held 2 cabinet meetings this year only on this issue. Qingduo, what makes this issue so hard to solve in China?
Well, the government, of course, in the very beginning, you can take some measures. For example, to cut the tariffs to 0. And you negotiate with the drug companies to lower the price. But remember, there are other procedures in the middle until it reaches into the hands of the patients. For example, at least one factor seems to be, or accusation against some Chinese hospitals. Remember, the Chinese doctors often, their salaries are quite low, and to compensate for their income, some hospitals would basically at the same time they sell drugs. They would buy the drugs. They would love the higher price drugs because there are kickbacks. And if the drugs are too cheap, they make too little, very little out of that. So there are incentives to somehow keep the drug high at some stages over there.
Okay, so siloed interests for separated departments within such a huge government and country. My last question goes to Mr. Polkinghorne. Maybe on Wednesday, an interesting development is President Trump signed his first drug pricing bill banning gag clauses which keep patients in the dark about how to save money on prescription drugs. What is your reaction? Do you see that an effective way in reducing drug prices?
I think so. I think I know one comment was made that in the U.S. we have a free market for drugs. I'm not so sure we do. I think there's tremendous opacity in terms of what any patient is paying. I think the more that you can create that direct visibility and incent the patient to find the best drug at the lowest price, I think is extraordinarily important. We're quickly moving into a global pharma world here. I think there should be a global price for a drug. I think it's kind of crazy to think we live in a world where the same drug has a completely different price depending upon what country you're in. That's not true for a can of Coke. That's not true for an iPhone. Of course, there are differences between what a Coke costs and an iPhone costs, but that should be basically the degree of differences that drug costs as we cross borders. So I think this is an important first step, but I think even around the world, we need to try to create that type of transparency.
Okay. Well, we have to leave it there. Very interesting topic, but time is running out. Many thanks to Xu Qingduo, Senior Fellow at the Pango Institution in Shanghai, Mark Xu, Chairman, CEO and President of Sinomic Pharmaceuticals, and William Polkinghorne, Co-founder and CEO of Driver. And that's it for this edition of The Point with me, Liu Xin. As always, you can follow me on Facebook and Twitter using the handle The Point with Alex. Download the application called CGTN to watch the show on your mobile devices, or go to YouTube and look for CGTN The Point. Thanks for watching. You've got The Point. Have a good weekend.